Yeah, we had the first leg of Treasuries 3s, 10s, and 30s offering, and the 3-year leg did not go well. It tailed. The metrics were all weak. I gave it D for demand and D for dog. And if you look at the market, interest rates had been going down. They turned. We know that stocks and rates have been joined at the hip, but that turn is something to pay attention to, and it came at a time where stocks were already making fresh lows on the session, and I do believe that the reversal in rates gave them a little bit of a push, and it does underscore that the relationship between Treasury yields and equities, well, it could morph at any time. We need to pay very close attention to a flight to safety trade is one thing, but starting to see rates maybe get a little more stubborn, especially on the long end, for a variety of reasons, is going to be the type of move stocks do not necessarily follow. And if you look at the yield curve right now, 2s, 3s, 5s, 7s, 10s, 20s, and 30s, every maturity is now higher on the day. So the auction really did reverse a lot of green back into red in terms of yields.
Rick, can you clear up a little bit of this market confusion, some of these talking points that say China's dumping treasuries in order to force our yields higher, make Besant look bad, and so forth? People argue it would be hard for their currency to weaken if that's the case, because if the currency weakens, don't they have to buy treasuries? And, oh, by the way, if we have inflation expectations going up like TIPS did, is it possible the tariff announcement yesterday was just pushing up inflation expectations and pushing up the 10-year, and this isn't so much a symptom of Chinese buying or selling?
I don't think I could agree with any of those assumptions, to be honest with you. The behavior in the dollar doesn't underscore a big liquidation in treasuries. I think what's going on in treasuries makes more sense when you look at it under the microscope of what's going on in equities. And as far as what's moving the market and what interpretations are and how all of this fits in, I think it's anybody's guess at this point. I do think that when we look at the dollar, we can't be very short-sighted. Look at a 25-year picture of the dollar index and see how much time it spends above or below 100. We could say we've weakened, but it's a during COVID, post-COVID move that's really reversing. In the grand scheme of things, our dollar historically is not weak at these levels. And to take another avenue, many believe that much capital in this country is here because of the strong dollar and the reserve currency. And for the first time in my lifetime, there's many people I normally agree with that think a reserve currency status may be something that we're better off without. Right. I'm not saying I agree with it, but there's a lot of moving parts here, and I think we shouldn't be superficial in some of these moves that really are not explained by the news of the day as much as everybody wants to connect those
dots. Enough. The exorbitant burden, as Michael Pettis calls it. But I think the administration wants that burden, right? It's an important tool of political leverage to be able to kind of impose sanctions and everything. But now they're trying to use a different economic regime to
I think
repair
the bigger story today is that the offshore yuan, which of course has a shorter history than the actual renminbi, that's the official, is at the all-time lows against the greenback. That, to me, is a very important story regarding China, and it underscores what the administration may have actually right on all of this, and that is many countries have a better thy neighbor approach to their currency because they're export economies.
So, and Rick, thank you. Let me just get a quick last comment from our panel. Brendan, I'll turn to you. What's the net effect here? If you have anything to add on what you think is going to happen with China's treasury buying, if the currency is weakening and now the U.S. isn't as open as a market, should the Europeans and others be worried that these goods are going to flood their markets?
I think they should absolutely be worried. Overproduction, over-manufacturing, excess supply. These are all themes that have been coming out of China really in the post-COVID years. And now I think if the United States is not a viable marketplace for China, absolutely the European Union, Australia, other parts of Southeast Asia, they could be dumping grounds for a lot of Chinese goods, a lot of Chinese product, and a lot of Chinese manufacturing. And that's a deflationary pressure. That's something that can ultimately weigh on global growth and cause a bit more turbulence in financial markets.
Mr. Leisman, a final word.
Just what Brendan is saying, you've blown a lot of things up, I guess is the best way to say it. From a world trade standpoint, things are up in the air. We don't know where they'll land. I think one of the things I'm concerned about are what you might call occluded losses. And we don't know, Kelly, where the losses are going to be among those who are going to be hit by the tariffs. That was one of the reasons, I think, for the extreme selling pressure Really, analysts don't know where it is. And in fact, I was talking about this morning, J.P. Morgan put out a spreadsheet for individual investors to look at individual companies to figure out how much tariff exposure they have, because all of this hit the market so quickly that analysts have not had an opportunity to analyze either every company or every industry. That's a process that's ongoing as we speak.
Perfect segue to Apple. Gentlemen, thanks. Steve Leisman, Brendan McKenna with Wells Fargo. We appreciate it. Actually, let's go to Diana first. On the back of the climbing 10-year yield, you know what that means for mortgage rates, people. Let's bring in Diana with that latest number. What do you see?
Well, Kelly, mortgage rates really reversed course this week, moving to the highest level in over a month today. The average rate on the 30-year fix jumped 22 basis points yesterday, another 3 today to 6.85%, according to Mortgage News Daily. This fully erased the decline from last week. So much like the stock market, the bond market has, of course, been on a roller coaster over the last week, and mortgage rates are along for the ride. Last week, the 30-year fixed dropped to the lowest level since last October. That was after President Trump announced the reciprocal tariffs. Now, that drop had housing watchers cheering a potential boost to the lackluster spring market. Mortgage rates had been moving in a very narrow range since the end of February, lower than last year, but really not by much. The biggest drop, actually, in rates so far this year wasn't last week. It was in January and February, when the 30-year fell from a high of 7.26% to 6.74%. But despite that drop, pending home sales, which are a measure of signed contracts on existing homes, it's the most recent indicator of activity in housing, it rose just 2% in February from January and was still close to 4% lower than the year before. So it's not just rates. Home buyers are also contending with high and still rising home prices and a growing lack of confidence in the broader economy and their own employment. And Kelly, one more stat I want to throw at you that I got from Redfin this morning. 1 in 5 home buyers will sell stock to fund their down payment. You think they want to sell stock right now?
That's a great stat. Something we were all debating is which would kind of hurt more. Would the weak stock market hurt more than the lower mortgage rates help? And now we don't have either one, I guess.
Exactly. It's 6 in one, half in the other. I think it's less about the daily rate moves on the mortgages and more about the broader economy, the stock market, and what people really want to do with their money right now. Single largest investment for most is their home.
All right. Diana, appreciate it. Diana Olick. Let's turn back to tariffs, as there's one name that's really been at the epicenter of this global trade war, especially as things ratchet up with China, and that's Apple. The stock is coming off its worst 3-day stretch since 2001. It's down 20% in just the past week. UBS among those saying Apple products could see big price hikes thanks to these levies. The cost of the iPhone 16 Pro Max rising 29% to $350. The iPhone 16 Pro could cost $120 more. Is this a once-in-2 decades buying opportunity after the sell-off we've seen? Our next guest says not so fast. Let's bring in Laura Martin. She's senior analyst at Needham. Laura, by the way, I mean, look, $350, $120, that's not as bad as estimates that the iPhone could cost $3,500. So the numbers do seem a little bit all over the place.
I mean, I think the thing that's incredibly important about tariffs is that they add about 50% to the cost of Apple. And so what happens is your $7.32 EPS estimate loses $2 if actually China stays at that 54% and India stays at 26%. So it's not the revenue that's the big question that tariffs brings. Tariffs brings this big question about what are the cost of goods sold and therefore how much falls to the bottom line and how much free cash flow does Apple have compared to what consensus estimates are. And most of us aren't changing our estimates because the situation is so fluid.
Oh, sure. Is there any way in which they can absorb this? I mean, at least in some meaningful aspect, absorb it into their bottom line?
I mean, we're assuming that they don't raise price, and they've said they're not going to raise price. So they're going to hold U.S. prices as steady as they can. But if they do that, then their costs go through the roof. Yes, they can pass 20% of the cost increase into consumers' hands. And so your iPhone, all those numbers you just gave, increased by hundreds and hundreds of dollars, which drives inflation in America. So we end up with higher bond yields.
Why don't you think this is a buying opportunity for Apple?
Oh, this isn't the worst case. This is the impact of a negative $2 on EPS for this year of $7 is where most analysts are, is only the direct impact of the Trump tariffs. If China retaliates, or if they invade Taiwan, much worse for Apple, right? So there's lots of worst cases for Apple. But again, it's just so hard to know. It's so hard to know what's actually going to happen with tariffs a week from now, 4 weeks from now. U.S. is 25% of the global GDP. So, anything that hurts trade hurts us $1 out of every $4. So
we just got a headline as well from the White House, Carolyn Leavitt at the press briefing, saying the president believes the U.S. has capability to make iPhones.
Yeah, I don't think that's a thing. I mean, our estimates are there would be 3x, whatever you thought, just quoted the price, 3x that. And you couldn't do it immediately. It takes years. India's taken like 3 years to get up to 14% of their iPhone volumes.
Right, exactly. And this has raised a lot of questions about the workforce. And can you literally, even if you had to turn the switch tomorrow, kind of turn to the American workforce to make these phones in the same way? I don't know whether anyone can figure that question out, but this is supposed to directionally tell us what's going to happen with EPS in the meantime. And I guess, like you said, if you went from $7 to $5 this year.
So if we were moving estimates and analysts aren't moving estimates because of the uncertainty, yes, we would go from $7 to $5. And that's just on the Trump tariffs alone, not anything worse than that yet.
What are the reverberations, Laura, you think, for the rest of the companies you cover?
So consumer confidence affects everything in advertising, and advertising has 80% margins. This morning, there was a study out from last week, 43% of people, CMOs, so chief marketing officers, said they were going to cut back spending in linear TV, cut back spending in social media, and cut back spending in like analog media, like yourself, for example, because that's what they need to offset the tariff cost increase. So they have a deliverable to their parent company. Because of tariffs, their costs on the goods that they're importing to the U.S. are going up. So they're going to cut marketing spend to offset that so they can hit their promised budget to their CEO this year.
Yeah, no, I think that makes a lot of sense. Obviously, companies have to look to cut where they can before they go into kind of the work base of their core operations. Would that put something like Netflix, which just got an upgrade today, it seems to be sitting in a nice insulated position from a lot of this, but does an advertising pullback affect them too?
Not really, because Netflix is very new to the advertising world, and they've been doing a very poor job of driving advertising growth. So no, I would say I agree with your prior speaker that Netflix is almost like a durable, that people can, if they can't afford the $20 Netflix price, they just go down to the $7 ad-driven tier.
All right, Laura, we'll leave it there as Netflix is still higher by about 2% today. Apple has given up its gains. It's down about 3%. Laura Martin from Needham, thanks as always for your time.
Thank you.
All the tariff turmoil is prompting economists to revise up their recession probabilities and for market strategists to revise down their year-end price targets. Our next guest is still standing by his 6,500 original price target, but does think we could see another 7 to 8% drop here if the White House doesn't back down on its plans. Mike Wilson is the CIO and chief U.S. equity strategist at Morgan Stanley. That price target is looking tougher by the day. Mike, welcome.
Yeah, how are you, Kelly? Good to see you.
Good to see you, too. So just kind of walk us through how you're thinking through all of this.
Well, I would say, first of all, we're not really talking about 12-month price targets in this kind of an environment. And I think, we came into this year pretty defensive in the first half. We talked about a tough first half and a potentially better second half. And so we've been very focused on our first half targets, which were sort of 5,500 to 6,100. We obviously went right through that on the announcements last Wednesday because they were worse than we expected. And those first half targets are coming down. And quite frankly, that's all people care about right now is how are we going to trade the next 2 or 3 months? And that's part of our offering, right? We're technicians. We know levels pretty well. We have a lot of information on flows and positioning. And I would say right now we're in a classic bear market. That's how we're trading. We're trading as a bear market. So it's all about technicals. And that's how we're really trying to help clients now, whether it's at the index level or it's at the stock level. And I think the price action in the last 2 days is very informative, right? We had very capitulatory behavior Monday morning. I mean, all of our signals that we look at were triggered. We had, positioning, sentiment, the RSIs, everything was there for a bounce. But that's all we're getting. We're getting a bounce. And I find it really interesting. Yesterday on the news for the false headline around the tariffs coming off, we kind of bounced to sort of 5,300. And then today, the whole rally, it just went right back to that same level. So what I would say is we're establishing a new range. That range is yesterday's lows, call it 4,850, to today's highs or yesterday's highs, which is around 5,300. And until further notice, that's the range that's going to get traded here on these headlines.
So is it significant to you that we're turning negative on the session today, that if we were to close negative again?
Well, it just means that we probably can go revisit the low end of the range. I don't think it tells you anything that we're going to have to take out that range. We're probably going to need some new information, more negative information, to probably take out yesterday's lows because it was so capitulatory. It was the highest volume day on record. We had liquidation. I mean, we had defensive stocks going down. We had, and as you noted earlier, you were talking earlier with Steve around the bond market. Part of the bond market sell-off was just people selling what they can sell rather than what they want to sell. Right, so we're seeing classic signs of sort of forced liquidation. That's capitulatory, right? So you're going to need something incrementally negative to take out the low end of that range, in my view.
I still would feel a little bit more comfortable in a weird way if the 10-year was at 390 right now.
Well, sure, that helps valuation, right? That makes the case that, okay, we've got there on valuation. And that's really probably the biggest, I think, hurdle right now is that we came in to this year with extremely high valuations. And I think, people trying to justify them, saying it's a new normal, whatever. And, high valuations are always a risk. And so, part of this correction, by the way, this correction started 4 months ago. It didn't start, 2, 3, 4 weeks ago with the tariffs escalating. This has been ongoing, which is part of our thesis, which is that the first half was going to see, growth negative effects from not only policy, but also the AI CapEx theme, which has kind of lost some of its luster. Also, the Fed, don't forget the Fed stopped cutting rates in December. So there's just an enormous number of headwinds beyond tariffs. Tariffs is catching everybody's attention because it's probably the one that has the most uncertainty to it. It's very hard to measure. But let's not kid ourselves. There's probably 3 or 4 or 5 other headwinds that have been weighing on stocks now for most of the year.
I spoke with Bill Miller over the weekend, who pointed to the fact that the last few times we've seen back-to-back 4% declines like we saw on Thursday and Friday, I think it was 1987, 2008, moments like that. And after 6, 9, 12 months, we were always higher. So I don't know if that gives comfort at a time like this or if it just points to just how big this dislocation is that we've been through. And just because we've been through it and because the worst may be over doesn't mean the market is, think back to 08, right? We had some real washout moments, but then there were also just kind of months of grinding and forming that bottoming process.
I couldn't have said it better myself. I mean, when you have this sort of action, you should be getting more bullish, not bearish, right? And that's why we're not throwing in the towel. That, and by the way, the 6,500 stands, but it's not necessarily in 6 months, right? It's sort of a longer term view that, the good part of the policy changes are still to come. That would be lower rates, fiscal consolidation, deregulation, perhaps incremental tax cuts, right? That stuff is on the second half of the agenda. And, the markets are discounting machines, right? And we peaked in November, December on the expectation that everything was going to continue on that pace, but the market's smarter, and it figured out that, no, that's not going to be what's happening. It's going to be, we're going to these growth headwinds. Well, who's to say that in 2 months, the market isn't looking ahead 6 months and saying, you know what, everybody's forgotten about these good things that could be coming down the pike. And the other thing I would say is that, the IT, excitement around that, it's really been excitement around AI CapEx. That's really it. But if you actually look at the IT spending for the last 2 years, it's been in a recession, just like most of the private economy. So, we've been talking about sort of a rolling recession at periods of time. I could see a rolling recovery where you don't really want to, focus just on the S&P 500, but there, parts of the economy are going to start recovering sooner because they've been going through such a tough time for the last 2 or 3 years. And that's really what our work we're trying to do now. But, in the moment today, it's about these technical features and the market trying to find a level. It's way too early to be making calls about a rolling recovery, but it's not as far out perhaps as you think.
Do you look at things like the home builders, which were green on Friday? I haven't checked the price action today. Do you look at an Apple, right? Down 30% year to date, down 20% in a week, red again today. I mean, are there areas where you can just say, the market has done so much work here that you can have conviction, or because of the tariff situation and Apple's unique supply chain, is it, just kind of stay away and wait for more information?
No, it's exactly what you said. We're looking for areas that have been, done so much work to the downside really for the last year or two. And I would say a few areas, we're not pulling the trigger. We've been underweight these areas, but, we're looking at them. Seems like home builders, things like consumer goods, where there's been, a lot of price deflation, perhaps even semiconductors and other parts of IT spending away from AI that, have had a tough time. These are areas that are ripe for, a bottoming process. It's probably too early, but to me, that's going to be what you should be focused on. You shouldn't be focused on trading index level, everything bottoming at the same day. There's some event that, brings in the all clear. That's what investing is all about. No different, by the way, when things get extended, you say, it's time to let go of this stuff. You know, like last year, a lot of stocks got extended, and it's like, this is in the valuations, you can't justify it, so we got to let it go. So, yeah, we're looking for areas that are more cyclical in nature. It's not there yet. They've been through a 2 or 3, kind of recession on their own. And that rolling recovery story is something that could perhaps play out in the second half as rates come down. Super interesting. Mike, thanks for bringing us that perspective today. Appreciate it. You bet. Mike Wilson with Morgan Stanley. One area we're watching are the cruise lines. Shares of Norwegian up 2% after being up nearly 7% earlier. Now, this comes on a big pivot. They hit a 52-week low yesterday. You got tariffs, tax questions, recession fears all weighing on the space this year. But some analysts have been turning bullish. We've talked about that, expecting a trade down on vacations to boost cruises. Let's talk to one of the key players now, Norwegian CEO Harry Sommer. Our Contessa Brewer brings us that. And Contessa, we appreciate it. There is just so much going on right now. It's great to hear from Harry. Welcome.
Yeah, it's been really interesting, Kelly, because here we are, Harry, at Sea Trade, which is the cruise industry's big conference. And you and your competitor CEOs were on stage today. Basically, the consensus is tariffs are not an immediate impact on supply chain. And are you susceptible to recession? Yes, but resilient. That being said, you're just off an earnings call where you said, look, 2025 is looking great. We've got all these forward bookings. How are you feeling about consumer sentiment, given all the changes that we're seeing in the markets?
I think, you said a lot of things. I'm going to try to unpack them to the best of my ability. We think at the forefront that cruising represents a fantastic value. When we study it, the average cruise is priced about 30% better than the average hotel vacation. And we're such a small percentage of the industry. We're about 2% of the overall global vacation market is cruising. So when you look at our low penetration, our great value, if you will, value gap with hotels, we think, I wouldn't say that we're recession proof, but I think when there are bad times, people still want to go on vacations. Cruising represents a tremendous value.
You haven't seen an automatic reversal of course, like forward bookings just plummeting because of the jitters that we're seeing shaking the markets.
Listen, there's no doubt that the last few days have been a little rocky for us. I think every company around the country is sort of living through these changes that we've gone through since last Wednesday. That being said, no dramatic U-turns. We have the benefit of being about 65 to 70% forward booked for the next 12 months. So 2025 is pretty much done. We're now looking maybe for late Q4 25, early 26 for bookings. We have time to be patient, and we will be patient.
There's a lot of talk this week about America bringing manufacturing back to the United States. And we used to be a big shipbuilding country, and we're not anymore. You're launching a new ship this week, built in Italy. Italy has a way of keeping the shipbuilding in Italy by financing the shipbuilding.
Sure.
Is that something that could work for America?
Really, it's an entire ecosystem that Italy and also Germany, France, Finland, there are 4 countries in Europe that build ships. All 4 of them have developed this comprehensive infrastructure. So yes, financing is definitely a piece of it. The Italian government supports the construction of ships for export, if you will, for use in international waters, and they give us very favorable terms. We have 3, 4, 5% interest rates, fixed over a 12-year period. It's great terms for us. It allows us to have good returns to our shareholders, our stakeholders, in financing the ships. But it's not just the financing. They've created an entire infrastructure, engine manufacturing, cabin manufacturing, theater manufacturing. The United States can get into these things, but I want to be clear, it takes years to develop that type of talent and infrastructure. So it's possible, but we need to embark on a multi-year, perhaps multi-decade path.
You mentioned the pandemic on stage today, said very dark. Aon and their marine expert said it is still the primary threat to the cruise industry. What have you learned from the pandemic, and how does it help you be resilient in the face of other economic headwinds?
We certainly don't see it as a primary threat to the industry. I'm not sure where Aon was getting their information from. The cases of COVID are way, way down. It's almost equivalent to the flu.
I think they meant a global pandemic.
Okay. There you go. We'll shift that a little bit to a global pandemic. I think we learned a lot. We learned a lot in terms of how to operate safely, how to operate in environments where there are unknown things like this happening. I wouldn't say that we necessarily did well during the time, but we learned a lot of lessons, and now cruising represents probably one of the safest vacations out there.
Harry, it's good of you to join us on a busy day here in Miami. And Kelly, it's been a really interesting view of how the cruise industry is riding these rough seas of tariffs that we've seen roil the markets.
Yeah.
Thank you for having me.
We really appreciate it. Hey, Harry, can you hear me, by the way?
Yes, I can, please.
Do you want to comment? You remember the Commerce Secretary made some accusations about your industry not paying taxes and so forth a few weeks back. Have you had a chance to respond to that?
Yes, we have. We actually headed out to D.C. last week, me and my fellow CEOs, to talk to our friends on Capitol Hill. So the truth is, cruise lines paid $2.5 billion in taxes to the federal, state, and local municipalities throughout the country in the United States. So any narrative that the cruise industry doesn't pay its fair share, doesn't pay taxes, is simply incorrect. In fact, we and there are other cruise lines actually have U.S. flag vessels that are subject to normal income tax structures as well. So we believe in the United States. We support the United States. We pay our fair share of taxes. I just want to be clear that, though, the administration has been great supporters of us as well. And I think I said this in the last earnings call, the work that they're doing to try to get peace between the Ukraine and Russia with the temporary ceasefire, the work they're trying to do now in the Middle East with Gaza and Israel, to the extent that those regions in the world can stabilize, that can unlock tremendous value for the cruising industry to go back to places that were very popular with our guests.
No, I appreciate the constructive attitude. You could work in diplomacy. Do you know where that came from, this idea that your industry was not paying taxes then? Is that just fake news?
I'm going to be honest, we don't. I don't know where it came from, but the people that we've talked to in Capitol Hill support the cruise industry. They realize not just the taxes that I mentioned that we pay, but the hundreds of thousands of jobs around the country that we support. Our ships visit 19 states and territories in the United States, and we source things like beef and grain and things like that, pretty much from all 50 states in the U.S. So we believe we're a great engine for the U.S. economy as we source all these things locally, and we plan to continue to be that way.
All right, Harry, Contessa, thanks. We appreciate it today. Norwegian's Harry Summer, our own Contessa Brewer. To Bertha Coombs now for the CNBC News Update. Bertha?
Kelly, the Justice Department is disbanding its national cryptocurrency enforcement team effective immediately. According to a memo sent Monday night by Deputy Attorney General Todd Blanche, the U.S. Attorney's Office will take over digital assets cases that involve criminal matters, including terrorism, while the Market Integrity and Major Frauds Unit will stop pursuing cryptocurrency cases in favor of immigration fraud. At least 27 people died when a roof of a nightclub collapsed overnight in the Dominican capital of Santo Domingo. According to local police, a provincial governor is among the dead. Police say at least 134 people were injured. And the South Korean military said it fired warning shots after 10 North Korean soldiers crossed the border today. South Korean officials say it was not a deliberate crossing. However, the motive behind the crossing remains unclear. Kelly?
All right, Bertha, thank you very much. Financials are the best performing sector today, and the XLF was on pace for its best day since early November. Earlier on, of course, we've lost some steam here. Shares of the big banks are also still 20% or more off their recent highs. Citi's down nearly 30% as macro concerns persist. And the first ever CNBC CEO Council poll, the majority of respondents see a recession before the end of this year. And remember, CEOs are usually optimistic. JPM raised its recession odds to 60% and maybe even higher last week. My next guest is a CEO who's not yet in the recession camp. Joining me now is Ron Kruszewski. He is the chairman and CEO of Stifel. Ron, I've been looking forward to checking in with you, especially, I thought if you came on when we were down 1,000 with some concern, then I thought, well, if you come on when we're positive, that would be, and now we're negative again. So it just goes to show these are crazy times.
Great to see you, Kelly. Yeah, it is kind of crazy times, but not really that unexpected, to be honest with you.
Really? You think so?
Well, look, at the beginning of the year, we had the lowest S&P forecast of any firm on the street. We're at 5,500. We said then that valuations were high and there was going to be turmoil in the market, primarily the threat of tariffs that we thought would be inflationary, tie the Fed's hands, and we just thought the market was priced to perfection then. Now, what has happened here has happened very fast, so much faster than we thought. But the basis that this was going to kind of happen, I mean, President Trump ran on this. So let's not lose sight of that. Now, furthermore, I would say, Kelly, that what is happening here is the first big step to a recalibration of trade policies that have gotten unfair to the United States. It's a huge step, But the president's transactional. He carpet bombs first and negotiates second. And that's what we're seeing. So you got to be a little careful not to think this is the new normal. This tariff situation is not the new normal.
I'm glad that you said that. I want to come back to that. But you guys have a lot of skin in the game as kind of a deal firm, advisory, investment banking, and so forth, where we've really seen a stall so far under his administration. So when you're kind of advising or positioning the firm, and when you say, look, you got to take them at their word, this is what they're doing, that could further interrupt business for the duration of the year, right?
I do. I mean, I think that this is not normal politics. Normal politics we'd have 10 state dinners to move the needle 1/100%. This is a much more, in your face, we're going to get it done approach, and it's causing some short-term pain. But look, we were talking 2 months ago, Kelly, about the unsustainability of the U.S. twin deficits being trade and the budget deficits. Interest exceeds defense spending. A lot of these things need to be recalibrated, and this is just, business approach in politics, and a lot of people aren't used to it.
So to put it a little bit more bluntly, and maybe this is unfair, but if you kind of see what they're trying to do and understand how it could hurt business, I mean, would you go so far as lay? You don't want your staff to sit around doing nothing, right?
We're busy. I mean, look, right now is the time that we need to be talking to investors. We cautioned investors at the beginning of the year that valuations were extended. We're telling investors now that it's a time to wade into stocks. A typical recession would take the S&P 500 to 4,400. 4,400 from the high of what was 61, 40, or 50. So the market's telling you a 60% chance of recession. But I will tell you something, the upside from here now is where you would wade in. There are some great companies on sale in the United States right now.
So talk a little bit about that and how you're going to steer a financial firm through what could be a coming recession, whatever international business you had done. I don't know how that's being affected. And again, there are now a lot of reasons why people need to tap your brain power to figure out what to do in this environment. But this is going to be a reshaping of a year, it sounds like.
Well, it is, and I think that's, again, everyone's very nervous because politics doesn't normally work this way. I mean, look, politicians cajole. They cajole people, and it takes years to get some of this done. I've never described President Trump as a cajoler. He's again, transactional, and it's very difficult to do an M&A transaction or run a business if you're not sure what your cost of goods sold is. Think tariffs. Exactly. If you don't know what it costs to put something together, that's hard. And second of all, we have a tax bill coming down the pike where it appears that every line item is up for discussion. So that uncertainty makes for a difficult environment. But I think it's short term, and I think that in the long run, it's a step towards making the United States stronger economically speaking. Our allies, our best allies, have overproduced and oversaved, and we have funded that through twin deficits, and that needs to be recalibrated.
But I just wonder what that looks like. I mean, some say that'll mean it's less of a financialization of the economy. It's a reindustrialization, and you're a financial firm.
Hey, we're at the fulcrum of savers and investors, and so we're feeling the short-term uncertainty for sure. We're really adding value by helping investors understand where they should be allocating money in this market. And I feel that, frankly, Kelly, I feel that we called this right up to this point. We started the year cautious. I'm sitting here today saying it's an opportunity. Call me back on your show and tell me I was wrong. Okay, that's fine. But I think that longer term, what you're seeing here is an administration that wants to make some changes in what has been an 80-year world order of globalization is being recalibrated here. It's just being done a lot faster than most politicians would do.
Well, kudos,
a lot faster.
Absolutely, and kudos to Barry, kudos to the rest of the team and everybody for trying to kind of help people now. And as you say, you think this is the time to start thinking about getting back in. Ron, really glad you could join us today. Thanks so much. Ron
You got it.
Kruszewski.
Thank you, Kelly. Good to see you.
You too, Chairman and CEO of Stifel Financial. As we head to break, take a quick look at stocks. The Nasdaq is back in the green after erasing its 5% earlier gain and then turning briefly negative. The Russells, the small caps, are still down about 1%. We'll be right back.
So this is the best dish to me in Vietnam. Good. Childhood flavor.
Hi everyone, my name is Thủy Tiên and welcome to Ho Chi Minh City. Lotto is the name of the game, just like bingo in America.
Vietnamese people drink coffee every day. If you drink the Vietnamese coffee, you can recognize the difference in the Vietnamese Robusta beans. It's a very strong, very resilient beans. Bitter.
I think it's quite hard to the foreigners to imagine what they have in Cơm Tấm. You can find a lot of different kind of seafood here because we have a long coaster. It's like the time when you're feasting and socializing with your friends and family. 1, 2, 3, go! Join me during my downtime.
Welcome back. We're watching the tech names giving back much of their early rally, especially Apple, which is down more than 2%. Nvidia's hanging on to a 2.5% gain. It's right around $100 a share. But tariffs continue to be a question mark. Even Nvidia, as I mentioned, which was up 8% at its highs today, has given up the bulk of that. Deirdre Bosa has more in Tech Check. Deirdre?
Kelly, it was an extremely short-lived rally, even for the AI trade, and even as positive signals on the demand side, we get them, but they succumb to pressures on the supply side and growing challenges for tech amid the new Trump administration that so far suggests the policy environment is not any more favorable, may even be more hostile for tech. Tech leaders that courted favor, they likely hope for more relief. Instead, tariffs are looming, FTC and DOJ lawsuits persist, and now their ability to build out compute capacity for the biggest technology shift of at least a generation, that is threatened. Take Oracle founder and Trump supporter Larry Ellison. He stood at the White House podium in January, pledging to build out a $500 billion AI infrastructure project, Project Stargate, in America with OpenAI and SoftBank that would be a catalyst for growth and job creation and secure U.S. leadership in AI. This week, the information reporting that Oracle is now rushing to finish a separate data center for OpenAI before tariffs make the servers and other materials a lot more expensive. Then there's Apple. You mentioned that in the lead-in, Kelly, falling into the red today. No guarantee that Tim Cook's playbook during that first Trump administration will work this time around, and it will be able to avoid rising iPhone costs. That's what we're seeing play out in the stock price. Tomorrow, I'm going to bring you an exclusive interview with Google Cloud's chief Thomas Kurian from the MegaCap's Next Cloud event. This is key. There's lots of things we can touch on, like AI spending, the regulatory environment. Remember that they are planning Google's biggest acquisition ever. That's Wiz. And also how he and Google plan to navigate these new tariffs, especially as, you know, their CapEx is among the largest, $75 billion, and they have big plans to build data centers.
Very much looking forward to it. Deirdre, thanks for now. Appreciate it. Deirdre Bosa, that's it for us. Thank you for watching The Exchange, and I'll join Brian Sullivan for Power Lunch right after this break.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
Everything we ever create, it's so a person can do something they couldn't do before.
It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
You guys all have an amazing heart, okay?
Squawk Box, weeknights.
Every new vehicle we put out, we're improving fuel economy and emissions.
We need a balanced and a fair energy transition for everyone.
The total value chain of battery will be very important.
Improve our operational efficiencies and reduce the consumption of natural resources.
Environmental sustainability is a must, and energy security is another pillar.
Renewable energy is cheaper than electricity made from fossil energy in 90% of the world already today.
Fostering sustainability on CNBC.